My name is Seb Beloe. I'm a partner and head of research here at WHEB, and I'm going to be talking to you for about 10 minutes about the sustainability disclosure requirements that the FCA launched at the end of last year. Some of you may remember, actually, if you were at our annual investor conference, that was the day actually that the FCA published their policy statement. It feels like a very long time ago now. It's not really that long ago, but it's only now that the market is really beginning to get to grips with what this all means. And in fact, we had a meeting with the FCA on Friday, where we were talking to them about our approach for the sustainability impact label, which is the one that we will be hoping to use. So the SDR is really the UK's approach to providing a bit more structure and clarity in the sustainability investment market. The aim is fundamentally to help consumers and their advisors navigate the different types of sustainability investments that are available, and also to make it more difficult for asset managers to label their products as sustainability investments unless they really are focused on achieving clear sustainability objectives. So I'll talk a bit more later on about what we think of the policy statement, but in general, we very much welcome it. We think it's very important to have clearer guidance from the FCA as to what they think asset managers need to do to label and market their products as sustainability investments. I don't know how many of you bothered to download the 200 odd pages of the policy statement, let alone actually read it all, but I've pretty much read it all. So I'm going to try and highlight some of the key points that we think are important, and as well as how WHEB is planning to respond to it. So this is a stylized map of the investment landscape that actually appears in the policy statement, and I think it provides a helpful overview of what the FCA is seeking to achieve. The first point is that it is quite complicated, but at least from the FCA's perspective, the key point is that they're trying to draw a bright line, which is shown by that dotted line, between, on the left-hand side, investment approaches that just have sustainability characteristics, and those on the right-hand side that specifically target particular positive sustainability outcomes. So on the left-hand side, there may be many reasons to use sustainability data in your investment approach. For example, you may think it helps you avoid risks or find opportunities. And fund managers have developed a variety of approaches to use sustainability data to do this. For example, through ESG screening and integration, or through stewardship or other types of positive or negative screening. But unless the approaches are specifically aimed at achieving a positive sustainability outcome, as opposed to just a financial outcome, then products using these approaches will not qualify for a sustainability label, nor indeed will they be allowed to use terms like sustainable or sustainability or impact in their naming and marketing. In contrast, products on the right-hand side will have a stated intention in their sustainability objective to achieve positive sustainability outcomes. This might be, for example, to invest in assets that are considered to be environmentally or socially sustainable, which is the requirement for the sustainability focus label. It might be to invest in assets that have the potential to become sustainable over time. That's the improvers label. Or to invest in assets that achieve a predefined, measurable environmental or social impact, as is the case for the sustainability impact label. Or the product can have a mix of all three, which is the mixed goals label. So the FCA really, what they've done is they've taken a look at the market today and identified these three types of approaches that I think we all probably can recognize, and we think that makes sense. But the focus of the policy statement is really to require real rigor in how managers address these different areas. And so these are the three labels. The fourth is obviously the mixed goals, which is a combination of those other three. The FCA do not want this to be seen as a hierarchy, and certainly from our perspective, we also see that each of the approaches has a role to play. the sustainability focus, as I said, is primarily focused on assets that are environmentally or socially sustainable. So, for example, this might be an approach that invests in assets that are aligned with the Paris Agreement on tackling climate change. As the manager, you then have to set key performance indicators that measure the ongoing sustainability of the assets that you've invested in. And any stewardship that you do must be explicitly linked with this. So, maintaining the ongoing sustainability of those assets. With improvers, if we use that climate change example, the objective here would be to invest in companies that have the potential to be aligned with the Paris Agreement. And then the key performance indicators have to track progress against that objective. So how are the companies that you invest in, or the assets that you invest in, how are they becoming more aligned over time with the Paris Agreement? And clearly, stewardship is the key element in the improvers label in getting companies to improve, to become more aligned. And then finally, with the impact, the sustainability impact label, here the objective is to invest in assets that achieve a positive, measurable social or environmental impact. So sticking with our carbon theme, the objective here would have to be something like investing in assets that provide solutions to climate change by reducing carbon emissions. And again, the key performance indicators would need to be focused on measuring the positive impact, for example, through tons of carbon emissions that are avoided, or megawatt hours of renewable energy. And then the stewardship would need to be focused on that specific objective. In other words, engaging with companies to encourage and support the delivery of their positive impact. So that's basically the three labels in a bit more detail. On the right, we've got a little pie chart here, which is one of the relatively few bits of data that we've seen trying to forecast how the market is going to embrace these different labels. The FCA themselves have said that they only think about 5% of funds on the market in the UK will seek to have a label. That's about 300 funds. And then Morningstar have did a piece of work a couple of months ago that tries to forecast which labels are going to be most popular. And in their research, which largely tallies with our view, I think, is that the sustainability focus will probably be the most popular label. Around 40% of labeled funds will be in that category. About 30% will use the mixed goals label, and then 14% in improvers and 11% in impact. So at one level, all that sounds quite benign, really, and largely reflective of the types of product that we see on the market today already. But the real challenge from our perspective as asset managers, and the real value as well, is that the SDR is really focusing on making sure that these objectives run through the whole investment process, like the figurative stick of rock. So for all of the labels, of the four labels, the first and most important thing is the articulation of the sustainability objective. This needs to align with one of the three labels, and needs to be clear, specific, and measurable. This then needs to be implemented through a sustainability investment strategy and policy. This needs to show how assets are selected using a, quote, robust, evidence-based measure of sustainability, standard of sustainability. And this has to be an absolute measure as well. So, for example, selecting assets on the basis of ESG ratings is definitively not considered sufficient for any of the labels. So, for example, if the objective is to invest in companies that are aligned with the Paris Agreement, as we were saying earlier on, then the robust measure of sustainability that is used for asset selection must be based on an absolute measure of the asset's carbon emissions. We can't use ESG or a relative rating. In each case, each of the labels, you have to have at least 70% of the assets need to be aligned with the sustainability objective that you've set, and none of the remaining 30% can be invested in assets that undermine that objective. This will probably make it very difficult for passive funds to fit in the improvers label. That's probably the one that they're most likely to fit in, as they would need to show how they are engaging at least 70% of the assets in the fund in order to qualify for the label. And then there are also requirements in terms of resources and governance that you have to demonstrate as a manager. And then the KPIs that we've talked about already, they need to link directly to that objective. So for us, with our sustainability impact label, the KPIs need to show how we are achieving our objective. So for example, how our investments are leading to reduced carbon emissions that we have to measure, or on the social side, how they're leading to better healthcare outcomes, more education, and so on. And this applies to the stewardship as well. You have to have KPIs for your stewardship activity, and this too needs to be directly aligned with the sustainability objective. So for example, if that objective is about tackling climate change, then the stewardship you do needs to be focused on climate change if you want it to support your use of the label. So work on wider issues like diversity, while very valuable, would not be seen as contributing to the label that you're selecting. So this is all quite demanding, actually, and we think we're pretty well placed because we've always been very clear about our intention to have a positive impact, and the measurement we do through our impact calculator and so on should be very helpful. But there is a lot of work here to make sure that you're being clear and aligned and consistent through your entire investment process. And one of the things that the FCA go on about is that these are retail labels, and so their guiding principle really is that it needs to be clear and understandable to a retail investor, and that's what you have to bear in mind as you're developing your submission for the FCA. So ultimately, what do we think the impact will be? Well, we do think it's going to be substantial. As I said earlier, the regime is intended to capture strategies that are already on the market, but what the SDR introduces is requirements for a much more rigorous approach in showing the sustainability objective that you've set for yourself is central to the activities of the manager, and that you have to document and report this quite extensively as well. We do welcome it. We think it really will force anyone who wants to use a sustainability label to really think hard and invest in the capacity to do this properly, and also to make it understandable to retail investors, which ties in with the consumer duty requirements. Again, we think we're pretty well placed because having a positive impact is something that retail investors generally get pretty intuitively. So we're confident, fingers crossed, that we'll be successful in our application to use the sustainability impact label. A couple of other points just to make before I finish. The approach is principles-based, is principles-based, yes, rather than prescriptive. Again, we welcome this. It does make it more difficult to start with because it's not always entirely clear what the FCA are looking for, and we had our meeting last Friday with them, which was very helpful in clarifying a few points. But over the longer term, we think it's a much better approach than the more prescriptive route that the FDR has taken so far, which is very rigid, really, and prevents innovation, and ultimately we think is a less efficient approach than the approach that the principal approach that the SDR uses. And then finally, for the impact nerds among you, we were relieved to see that the final policy statement did not focus on concepts like additionality and causality, but instead focused on intentionality and contribution. In other words, you have to show as an impact manager that your investment policy and process is focused on delivering impact. That's your intentionality. And you also have to measure the ultimate outcome that you're aiming for in terms of avoided emissions or better healthcare. But you don't have to prove that it happened because of you. That's the additionality and causality point, which we think is pretty much impossible in listed markets or in many markets. And so we think this focus on contribution and on intentionality is the reasonable standard to set. The SDR is complemented by anti-greenwashing rules and by naming and marketing rules. And in fact, yesterday, the FCA published a consultation paper on how the SDR framework will apply to model portfolio services. We also believe that in time, they will roll this approach out to institutional markets like pension funds as well. So the next step, just with the timeline at the bottom, is the anti-greenwashing rules, which come into force at the end of May. The model portfolio services consultation ends in the middle of June, and then managers can start using the labels themselves at the end of July. The naming and marketing rules and the NPS rules will come into force in December. And at that point, managers who do not have a label will not be able to use terms like sustainable and sustainability and impact and environmental. There's a whole range of words that they won't be able to use in their naming and marketing.